During President Donald Trump's second term, his administration embarked on an aggressive and unpredictable tariff campaign that not only aimed to reshape North American trade, but also sent shockwaves through global markets. What began on February 4, 2025, with the imposition of a 25% tariff on imports from both Mexico and Canada and an additional 10% tariff on Chinese goods, quickly spiraled into a multifaceted economic crisis with profound political repercussions. On February 4, 2025, President Trump signed executive orders that set the stage for a dramatic escalation in trade tensions. Citing concerns over trade imbalances and national security, particularly related to the flow of fentanyl into the United States, his administration slapped a 25% tariff on imports from Mexico and Canada. At the same time, an extra 10% tariff was imposed on Chinese goods, a move that many experts later argued was more about rebalancing manufacturing than about addressing the drug crisis. Less than 2 weeks later, on February 13th, 2025, the White House unveiled the Fair and Reciprocal Plan, a framework intended to counter what the administration characterized as non-reciprocal trade practices by nations including Brazil, India, and members of the European Union. This plan highlighted the disparities in tariff structures worldwide and positioned the U.S. as a champion of fair trade. However, the intended message was muddied by the swift backlash from its trading partners, who saw these measures as a blatant overreach. Before we continue, if this breakdown of Trump's tariff miscalculations is resonating with you, please hit that like button, share this video, and subscribe for further expert insights into global economic trends. Your engagement is crucial in keeping you informed and ahead of these rapid developments. By February 27th, tensions escalated further when President Trump announced an additional 10% tariff on all Chinese imports, effective March 4th, 2025. This decision, justified by claims that China had not done enough to curb fentanyl inflows into the United States, only served to exacerbate existing disputes with Beijing. The very next day, February 28th, the administration signaled its willingness to expand its protectionist stance, hinting at the potential imposition of tariffs on imports from the European Union and other key trading partners. Amid these rapid-fire policy shifts, American businesses and economic analysts began to express growing concerns about the unpredictability of the administration's trade strategy. The uncertainty was palpable, and on March 3, 2025, in a surprising turn, President Trump issued an executive order suspending some of the newly imposed tariffs on certain goods from Mexico and Canada. This pause was widely interpreted as an attempt to stabilize volatile markets and mitigate domestic fallout. Yet just a day later, on March 4th, the 10% tariff on Chinese goods went into effect, triggering swift retaliatory actions from Beijing. Retaliation that included up to 15% duties on U.S. agricultural products. Almost immediately, the economic repercussions of these erratic tariff policies became evident. On March 5, 2025, the Dow Jones Industrial Average plummeted by more than 300 points over just 2 days, reflecting widespread investor anxiety. The abrupt shifts and reversals in policy led to heightened market volatility, as businesses struggled to forecast costs and adjust supply chains. One of the most telling indicators of the crisis was the sharp decline in the U.S. dollar. Historically viewed as a safe haven in times of economic turbulence, the dollar was rattled by Trump's tariff maneuvers. Confusing policy shifts, abrupt reversals, and inconsistent messaging prompted investors to shed their dollar positions, leading to a steep depreciation of the greenback. The dollar index, which measures the U.S. currency against a basket of major currencies, dropped approximately 5% from its early January high in a matter of weeks. Concurrently, the euro surged by about 3%, as market participants shifted their preferences in response to the U.S. policy uncertainty. This depreciation was not confined to the major currencies alone. Emerging market currencies, such as the Canadian dollar and Mexican peso, were also hammered following the tariff announcements, reflecting a broader sense of unease about North American trade stability. Safe haven currencies like the Japanese yen, meanwhile, experienced a rally as global investors sought refuge from the escalating trade conflict and the perceived risk of U.S. economic mismanagement. Inside the United States, the tariff policy's erratic nature began to take a toll on business and investor confidence. The constant cycle of tariff imposition, suspension, and re-imposition created a climate of policy whiplash that left companies hesitant to invest or commit resources. Analysts noted that long-term dollar bets evaporated as uncertainty reigned, with many firms delaying hiring and capital investments in the face of unpredictable trade conditions. The manufacturing sector, a key pillar of the U.S. economy, was particularly hard hit. Rising input costs due to the tariffs, especially on critical materials such as steel and aluminum, translated into compressed corporate margins and a slowdown in production. The ISM Manufacturing Index for February 2025 showed clear signs of contraction, underscoring the damaging impact of the administration's protectionist policies. Meanwhile, the Federal Reserve's Beige Book documented widespread concerns about how trade uncertainty was curbing growth and stifling the overall business climate. Commodity markets, too, were not spared. Oil prices, which had been buoyed by solid demand, began to swing unpredictably as tariff disputes threatened to disrupt global energy supplies. When tariffs were on the verge of implementation, prices of WTI and Brent crude slipped by 3 to 5% in a single tumultuous week, a clear sign that the market was bracing for a potential collapse in demand. Although some industrial commodities saw temporary spikes due to supply disruptions, the overall tone remained one of caution and uncertainty. In a striking departure from past administrations, the Trump-era policies even extended punitive tariffs to key U.S. allies. Targets included Canada and Mexico, longtime partners under NAFTA and the USMCA, along with other major trading partners in Europe. This strategy not only provoked immediate retaliatory actions, but also severely undermined global trust in the stability and reliability of U.S. policy. The administration's commitment to a protectionist trade regime has since been viewed as a major factor in the ongoing economic turbulence and the sharp decline of the U.S. dollar. The fallout from Trump's tariff policies has prompted a broader reassessment of the U.S. dollar's role in global trade. Once the unquestioned global reserve currency, the dollar is now facing growing competition from other currencies. As markets reacted to the uncertainty, several emerging economies began to explore alternative means of settling trade, leading to a trend known as de-dollarization, a gradual shift away from reliance on the U.S. dollar for international transactions. In Latin America, for instance, countries like Brazil, Argentina, and others have taken steps to conduct bilateral trade in local currencies, reducing their dependence on the greenback. This movement is not isolated. Similar trends are emerging in Europe and parts of Asia, where strategic decisions are being made to mitigate the risks associated with U.S. monetary policy swings. The combined effect of these shifts poses a long-term challenge to U.S. economic hegemony, as traditional allies and emerging markets alike begin to recalibrate their trade and investment strategies away from the dollar. While the Trump administration sought to assert its dominance through aggressive tariff policies, its closest allies in North America have not stood idly by. In response to the 25% tariff on imports and the 10% duty on energy products, Canada acted swiftly. Beyond imposing its own counter-tariffs on U.S. goods, Canada has signaled its willingness to take more drastic steps if the U.S. persists. Prime Minister Justin Trudeau and Ontario's Premier Doug Ford have been vocal in their opposition, with Ford specifically warning that Ontario could escalate by imposing a 25% tariff on electricity exports to key U.S. states. a measure that would affect millions of American homes and businesses in states like Michigan, New York, and Minnesota. Mexico, too, has shown its willingness to engage in retaliatory diplomacy. Following discussions with President Trump and a temporary suspension of certain tariffs until April 2, 2025, Mexican President Claudia Sheinbaum expressed gratitude for the cooperation in addressing border security and illegal immigration. However, these temporary pauses offer little relief, as the overall trajectory of the U.S. tariff policy remains unchanged, leaving Canada and Mexico to brace for further economic pressure. The consequences of these tariff policies extend well beyond economic metrics. Politically, Trump's unpredictable tariff agenda has fractured traditional alliances and altered the dynamics of international negotiations. The imposition of tariffs on close allies such as Canada and Mexico has led to bitter exchanges, with Canadian officials openly challenging U.S. assertions and seeking redress at the World Trade Organization. The public rhetoric, including remarks about annexing Canada as the 51st state, has only deepened the animosity and heightened tensions along the border. These actions have significant diplomatic repercussions. The erosion of trust between the United States and its traditional allies threatens to upend long-standing trade agreements and could lead to a reconfiguration of global trade alliances. As nations begin to question the reliability of U.S. policy, the likelihood of forming more stable, multipolar trading networks increases. In the long run, this realignment could diminish the strategic leverage that the United States has long enjoyed on the global stage. Perhaps the most visible sign of the policy miscalculation has been the precipitous decline of the U.S. dollar. Driven by a combination of sudden tariff reversals, conflicting policy announcements, and escalating global trade tensions, the dollar has lost its status as a safe haven. Global investors, uncertain of the administration's next move, have shifted their positions away from the greenback. The result has been a sharp drop in the dollar index by about 5% from early January highs, and a corresponding surge in alternative currencies like the euro and the yen. This depreciation has had a cascading effect on U.S. financial markets. The equity markets, already jittery from the constant policy shifts, have experienced severe volatility. The S&P 500 recorded one of its worst single-day sell-offs in years, as investors reacted to the mounting risk of an extended trade war and the potential for a broader economic downturn. In response, many have sought refuge in traditional safe havens like gold, driving prices to record highs. Meanwhile, corporate earnings are under pressure from increased input costs and disrupted supply chains, which further undermines investor confidence. Trump's tariff policies have not only rattled financial markets, but have also sent ripples through global supply chains. The North American manufacturing network, once the bedrock of integrated production, is now under threat as tariffs on critical materials, such as steel and aluminum, raise production costs. For industries that rely on cross-border cooperation, such as automotive manufacturing, this disruption could mean reduced competitiveness and long-term declines in output. The cascading effects are evident in various sectors of the economy. American farmers, for example, have been caught in the crossfire as retaliatory tariffs from China have imposed additional duties on agricultural exports. Similarly, U.S. industrial firms are grappling with uncertainty over future tariff rates, forcing many to delay or scale back capital investments. These measures have led to an overall slowdown in economic growth, with long-term implications that extend far beyond the immediate trade dispute. Furthermore, the interplay between trade policies and energy markets is creating a particularly precarious situation for the U.S. As Canada and Mexico leverage their critical role in supplying oil, natural gas, and electricity, any disruption in these supply lines could trigger a full-blown energy crisis. The potential for increased energy prices would not only hurt consumers, but also compound the cost pressures on U.S. industries, setting off a vicious cycle of reduced production, job losses, and further economic decline. In the end, Trump's miscalculation appears to have not only failed to achieve its intended goals, but has also undermined the stability of the U.S. economy. The aggressive tariff measures, intended to boost domestic manufacturing and secure a better trade balance, have instead isolated the United States from its long-standing allies and destabilized global markets. The U.S. dollar's sharp decline, coupled with the adverse effects on domestic industries and the energy sector, signals that the costs of such a protectionist approach may soon outweigh any perceived benefits. For Canada, Mexico, and other affected trading partners, the current crisis presents both a challenge and an opportunity. By mobilizing coordinated retaliatory measures and leveraging their natural resources and strategic positions, these nations are poised to not only protect their economies, but also potentially reshape global trade dynamics in their favor. The unwillingness of the U.S. to negotiate in good faith or to maintain a consistent, stable policy framework could have lasting implications, not just for its own economic leadership, but for the entire global trading system. The next phase of this unfolding drama remains uncertain. As market volatility persists and investor sentiment continues to sour, all eyes will be on the upcoming negotiations between the U.S. and its trading partners. While there is a glimmer of hope that some of the more damaging tariffs might be reconsidered or adjusted, the overall trajectory of Trump's protectionist policies suggests that the damage may be irreversible. Key questions loom large. Can the United States reverse course before the cumulative economic pressures force a policy shift? Will Canada and Mexico's coordinated response succeed in compelling the U.S. to rejoin the fold of multilateral trade cooperation? And how will global supply chains adapt to this new era of economic nationalism and tariff-induced uncertainty? If you found this analysis insightful, don't forget to like, share, and subscribe for more expert commentary on the unfolding global trade landscape. Your support helps us bring you the latest updates and deep dives into the issues that shape our world.